Imagine waking up to find that China, a global economic titan, has just sent shockwaves through the silver market. This isn't merely about a fluctuation in commodity prices. It's a seismic shift with profound implications. The recent maneuvers by China have upended traditional dynamics, causing ripples that threaten to destabilize not just local economies, but the global marketplace itself. Silver, often overshadowed by its more glamorous cousin gold, plays a crucial role in industries ranging from electronics to solar energy. When China, a major player in both production and consumption, makes a strategic move, the effects are felt worldwide. The immediate impact is observable in the volatility of silver prices, which have surged unpredictably. Investors, caught off guard, scramble to reassess their portfolios in light of this new reality. This isn't just about market speculation. It's about the fundamental economic shifts that could redefine global trade patterns. As China leverages its control over silver supplies, other nations find themselves at a crossroads. Do they pivot their strategies to accommodate this new power dynamic, or risk being left behind in an increasingly competitive global arena? In the short term, industries reliant on silver face skyrocketing costs, potentially leading to increased prices for consumers. The tech sector, in particular, feels the pinch, as silver is a key component in manufacturing essential electronics. This could have a domino effect, impacting everything from the price of smartphones to the rollout of green energy solutions. Moreover, the financial markets experience turbulence as traders attempt to navigate the uncertainties introduced by China's strategic gambit. But there's more at play here than just immediate economic consequences. China's actions could signify a broader shift in the global balance of power. By exerting influence over a crucial commodity, China positions itself as a formidable force capable of reshaping international trade and finance. This move forces other nations to reconsider their economic policies and alliances, potentially leading to a realignment of global economic relations. The urgency of the situation cannot be overstated. As nations grapple with the fallout, the specter of economic instability looms large. The potential for a cascading effect on global economies is real, prompting urgent discussions and negotiations at the highest levels. In this high-stakes game, the decisions made in the coming months will be pivotal, determining not just the fate of the silver market, but the future direction of the global economy itself. In the labyrinthine corridors of global finance, China's maneuvers in the silver market stand out as a masterstroke of strategic control and economic foresight. To begin unraveling this, we must first acknowledge the deliberate and calculated steps China has taken, driven by an intricate blend of national interests and global ambitions. At the heart of this strategy lies China's intention to consolidate its influence over precious metals, with silver being a particularly significant target due to its dual role as both an industrial and monetary metal. China's approach to the silver market is anchored in its broader economic policies, which prioritize resource accumulation and strategic stockpiling. By heavily investing in silver, China is not merely acquiring a valuable commodity. It is effectively setting the stage to dictate terms in the global market. This isn't just about buying, it's about creating leverage. When China buys silver in massive quantities, it influences the supply and demand dynamics, thereby impacting global prices. This kind of market manipulation is not just about immediate gains. It's a long-term play designed to enhance China's economic power. The ripple effects of these actions are profound. By holding vast reserves of silver, China gains a strategic advantage over countries that depend on stable silver prices for their industries. Silver is crucial for various technologies, including solar panels and electronics. By controlling this market, China can exert pressure on industries worldwide, potentially dictating terms and prices to nations that rely heavily on these technologies. Furthermore, China's strategic silver acquisitions align with its broader Belt and Road Initiative (BRI). This ambitious global development strategy involves infrastructure projects across numerous countries, many of which are rich in natural resources. By securing dominance in the silver market, China can ensure a steady supply of this critical resource for its BRI projects, reinforcing its economic and political influence across Asia, Africa, and beyond. The impact on international trade and finance is equally significant. China's actions inject volatility into global markets, leading to fluctuating commodity prices and currency valuations. For instance, nations heavily reliant on silver for industrial purposes might face increased costs, affecting their trade balances and economic stability. This volatility is a double-edged sword. While it can offer opportunities for savvy traders, it poses substantial risks to economies unable to adapt to rapid price changes. Moreover, China's manipulation of the silver market serves as a subtle yet powerful signal to the world. It is ready and willing to leverage its economic might to reshape global economic structures. This maneuver is not isolated but part of a broader strategy to challenge and eventually redefine existing financial norms and power distributions. For countries in the West, particularly those heavily invested in maintaining the current global economic order, this is a wake-up call, highlighting the need to reassess their economic strategies and alliances. As we delve deeper, it becomes clear that China's actions in the silver market are a microcosm of larger geopolitical shifts. They underscore a growing trend where economic power is increasingly wielded as a tool of influence and control. In this context, silver is more than just a commodity. It is a strategic asset in the chessboard of global economics. The consequences extend beyond finance, touching upon national security, technological advancement, and international diplomacy. This strategic manipulation of the silver market by China is a testament to its ability to play the long game, positioning itself not only as a dominant player in the realm of precious metals, but also as a formidable force in the global economic landscape. It challenges other nations to adapt, innovate, and perhaps most importantly, to recognize the shifting dynamics of power and influence in an increasingly interconnected world. China's recent maneuvers in the silver market have sent shockwaves through the global financial landscape, illustrating a complex web of consequences that ripple far beyond the initial impact. As China's strategic manipulation unfolded, it didn't just affect the supply and demand dynamics of silver. It triggered a cascade of reactions across stock markets, currency valuations, and commodity prices worldwide. Let's begin with stock markets. Investors, already jittery from ongoing global uncertainties, reacted swiftly. Major indices in the United States, Europe, and Asia experienced heightened volatility. The Dow Jones and Nasdaq saw abrupt fluctuations as traders scrambled to reassess their positions. In Europe, the FTSE and DAX mirrored this turbulence, with market sentiment heavily influenced by fears of broader economic repercussions. Share prices of companies directly linked to the silver industry, miners, refiners, and industrial users, swung sharply as investors speculated on the long-term implications of China's grip on this vital commodity. Currency markets, too, were not immune. The yuan, bolstered by China's assertive actions, gained strength, unsettling the delicate balance in forex markets. This appreciation put pressure on currencies of silver-exporting countries, whose economies are tethered to their mineral exports. The Mexican peso and Peruvian sol, for instance, faced downward pressure as investors recalibrated their expectations in light of China's newfound leverage. Meanwhile, the U.S. dollar, often seen as a safe haven, experienced mixed reactions, initially strengthening as investors sought stability, but later facing pressure as the market digested the broader economic implications. Commodity prices, interconnected as they are, also felt the tremors. Gold, often moving in tandem with silver, saw an uptick as investors sought refuge in the timeless store of value, hedging against potential market instability. Meanwhile, other industrial metals like copper and zinc experienced shifts in demand as market participants speculated about potential changes in global manufacturing output and supply chains. The broader commodities complex faced a reassessment, with oil prices oscillating as traders considered the economic slowdown implications of a disrupted silver market on global industrial activity. This intricate dance of market forces highlights how a single strategic move by China can send ripples across the globe, impacting nearly every facet of the financial system. Yet, this is not an isolated incident. Historical patterns suggest that China's influence on global markets has been a recurring theme, each episode offering valuable insights into the strategies and consequences of their economic maneuvers. Understanding these patterns is crucial for investors and policymakers alike as they navigate this turbulent landscape. seeking to anticipate the next move in this high-stakes game of global economics. China's fingerprints on the global market stretch back decades, and each touch leaves a mark that reverberates worldwide. Historically, China's influence has been a game-changer, whether through strategic currency devaluations, massive infrastructure projects, or aggressive market entries. Consider the late 20th century when China began opening its economy, gradually becoming the manufacturing hub of the world. This shift wasn't just about cheap labor. It was a strategic transformation that altered global supply chains and power dynamics. Countries worldwide found themselves either benefiting from or competing against China's burgeoning industrial might. Fast forward to the 2000s, China's entry into the World Trade Organization was a pivotal moment. It wasn't merely about trade agreements. It reshaped how economies interacted. U.S. and European markets saw an influx of affordable goods, which suppressed inflationary pressures but also decimated local industries unable to compete with China's low production costs. This entry into the WTO wasn't just a market move. It was a calculated strategy to position China as an indispensable player in the global economy. Investors and businesses worldwide had to recalibrate their strategies, often underestimating the long-term implications of such a tectonic shift. Then there's the Belt and Road Initiative, launched in 2013. This isn't just infrastructure. It's a modern Silk Road, a grand vision to extend China's influence across Asia, Africa, and Europe. The strategy? Bind countries to China through debt, creating economic dependencies that translate into political leverage. This initiative shows China's ability to think long-term, using economic tools as instruments of power. It's a lesson in how financial strategies can be wielded like a chess game, with China often several moves ahead. Now, let's talk about China's handling of its currency, the yuan. In 2015, China devalued the yuan, sending shockwaves through global markets. This wasn't a mere adjustment. It was a strategic maneuver to boost exports and maintain competitiveness amidst a slowing domestic economy. The ripple effects were immediate, with markets reacting in panic, showcasing China's ability to influence global finance through monetary policy alone. This move highlighted a pattern. When China's economy faces internal challenges, it often turns outward, impacting global markets in ways that secure its domestic stability. Today, China's maneuver in the silver market is not an isolated incident, but a continuation of its strategic playbook. By subtly manipulating market dynamics, China demonstrates a persistent pattern of using economic levers to exert influence. The silver market, like many others before it, becomes a stage where China can flex its economic muscles, sending tremors across financial landscapes. This pattern is not just about dominance. It's about ensuring that no global economic narrative can be written without mentioning China's role. Historically, each strategic move by China has been met with a mix of awe and apprehension. The global economy has learned to pivot around China's actions, adapting to the shifts in power and influence. Understanding this historical context is crucial because it reveals a consistent strategy of leveraging economic tools to achieve broader geopolitical aims. As the world watches China's current moves in the silver market, it's essential to recognize the echoes of past strategies and anticipate how these might manifest in future scenarios. The narrative of China's influence on global markets is one of strategic foresight and calculated risk. It's a reminder that behind every market move is a story of ambition and power, often unseen but deeply felt. As we delve into economic theories in our next exploration, this historical context provides the foundation to understand how China's current actions might unfold in the grand tapestry of global economic dynamics. Imagine waking up to a world where the silver market is no longer dictated by traditional forces of supply and demand, but rather by a single country's strategic maneuvers. This is not fiction. This is China's latest play. Economic theories provide a lens to interpret such dramatic shifts. One such theory is the command economy influence, suggesting that when a nation with significant state control over its economy intervenes in global markets, it can cause ripple effects far beyond its borders. China's state-driven policies, including its substantial reserves and control over domestic industries, allow it to influence prices and availability of key commodities like silver. By stockpiling or releasing silver, China can create artificial scarcity or abundance, reshaping market dynamics overnight. Experts are divided on the potential outcomes of this manipulation. Some believe that China's actions could stabilize its own economy by securing vital resources necessary for its technological and industrial expansion. However, others warn of a more perilous scenario, a domino effect collapse. This theory suggests that artificial market manipulations could lead to a series of economic disturbances globally. If China's actions cause silver prices to plummet or soar unpredictably, it could destabilize industries reliant on this metal, from electronics to solar panels, triggering a chain reaction of failures and bankruptcies. Looking forward, we must consider expert predictions that paint a spectrum of potential futures. On one hand, optimistic analysts propose the new equilibrium hypothesis, where China's manipulation leads to a recalibration of global supply chains. This could potentially result in more efficient resource allocation and even spur innovations as industries adapt to new realities. In this scenario, the global economy might emerge more resilient, with diversified supply chains reducing dependency on any single market. Conversely, pessimists point to the volatility spiral scenario. Here, continuous manipulation and counter-manipulation by other nations could lead to a highly volatile global market. Such instability might not only deter investment, but also exacerbate geopolitical tensions as countries scramble to protect their interests. This could lead to protectionist policies, trade wars, and a fragmented global economy, echoing the economic nationalism seen in the early 20th century. Moreover, the psychological aspect cannot be ignored. Market perception plays a crucial role, and fear can be as contagious as any economic factor. The market psychology theory suggests that if investors lose confidence due to perceived or actual market manipulation, it could lead to a withdrawal of investments, further destabilizing economies. The mere anticipation of China's next move can create a climate of uncertainty, influencing everything from stock markets to consumer confidence. As we navigate these possibilities, it's clear that the stakes are incredibly high. China's ability to manipulate the silver market is not just a financial maneuver, but a strategic power play with the potential to redefine global economic landscapes. Understanding these economic theories and predictions allows us to glimpse into possible futures, preparing us for a world where traditional rules may no longer apply. In the end, the question remains, will China's gamble pay off, or are we witnessing the beginning of a new era of economic turmoil? The world stands on the precipice of what could be a monumental shift. China's recent maneuvers in the silver market have sent ripples across the global economy, raising the question, is this the tipping point for a worldwide economic collapse? The idea isn't just provocative. It's rooted in a series of unfolding events that collectively paint a picture of impending instability. To understand the gravity, we must first examine the interconnectedness of global markets. Silver, often seen as a safe haven asset, plays a crucial role in various industries, from electronics to solar energy. A disruption in its supply chain or pricing can have cascading effects, leading to increased costs in manufacturing and, ultimately, higher consumer prices. This scenario contributes to inflationary pressures already felt worldwide. Moreover, China's influence extends beyond mere commodities. Its role as a major creditor to numerous nations means any economic downturn within its borders could trigger a domino effect. Countries heavily reliant on Chinese loans and trade may find themselves in precarious positions should China decide to tighten its purse strings or redirect its economic focus inward. Such a move could exacerbate existing vulnerabilities, especially in emerging markets struggling to regain footing post-pandemic. On the flip side, some optimists argue that the global economy possesses inherent resilience. They point to the adaptability of industries and the financial sector's capacity to absorb shocks. Central banks around the world have tools at their disposal, including interest rate adjustments and quantitative easing, to mitigate potential downturns. The argument follows that while markets may wobble, they won't necessarily crumble. This perspective hinges on the belief in a balanced economic recovery, driven by technological advancements and diversified supply chains that reduce dependency on any single market. Yet, The real challenge lies in geopolitical tensions that have been simmering beneath the surface. Trade wars, political unrest, and shifting alliances contribute to a fragile global landscape. In such an environment, economic shocks are not isolated incidents, but part of a larger tapestry of instability. The question then becomes, how do we navigate this labyrinth? The answer may lie in a multifaceted approach that emphasizes strategic foresight and flexibility. As businesses and investors contemplate their next moves, the lessons are clear. Diversification, both in investments and supply chains, is critical. Reliance on a single market or commodity can no longer be the norm. Instead, a proactive stance that anticipates market shifts and geopolitical shifts will be essential. The silver market disruption serves as a stark reminder that in today's interconnected world, no economy operates in a vacuum. The ripple effects of China's actions could indeed be the final straw that brings about significant reevaluation of global economic strategies. In the wake of the silver market upheaval orchestrated by China, a few critical lessons emerge for businesses and investors alike. First, volatility is not just a feature of the market, it's a constant. Those who navigate these turbulent waters successfully understand that market fluctuations can occur at any moment, often triggered by geopolitical maneuvers. In this case, China's actions serve as a stark reminder that economic powerhouses can sway global markets with a single strategic move. To safeguard against such unpredictability, diversification becomes paramount. Investors should not place all their bets on a single asset class, no matter how promising it may seem. The silver debacle illustrates that even commodities perceived as safe havens can experience dramatic swings. A well-balanced portfolio that includes a mix of equities, bonds, and alternative assets can cushion against the shocks of a volatile market. Moreover, businesses need to adopt a proactive approach to risk management. This entails not only hedging against currency and commodity risks, but also keeping a keen eye on geopolitical developments. By anticipating potential disruptions and planning accordingly, companies can mitigate the impacts of sudden market shifts. Understanding the broader economic landscape allows businesses to adapt their strategies and remain resilient in the face of uncertainty. Additionally, the importance of staying informed cannot be overstated. In an era where information is abundant yet often overwhelming, discerning investors and business leaders must cultivate the ability to filter through noise and focus on actionable insights. This means subscribing to credible sources, engaging with expert analyses, and continuously educating oneself about market dynamics. In doing so, they can make informed decisions that align with their long-term objectives. Finally, fostering a mindset of agility and adaptability is crucial. Markets are in a perpetual state of flux, and those who cling to rigid strategies risk being left behind. By embracing change and remaining open to new opportunities, investors and businesses can turn potential threats into avenues for growth. The silver market turmoil is a testament to the ever-evolving nature of the global economy, where those who adapt thrive, while those who resist change falter.